This week, US inflation jumped to 3.8%. And the word transitory is probably one central bankers around the world regret ever using. Because inflation increasingly looks like it may stay above target for much longer than many investors expected. And in that environment, inflation-linked bonds sound like a brilliant idea. Inflation rises, and these bonds are specifically designed to protect against inflation. Except a few years ago, the internet, and especially Reddit, was full of investors who bought inflation-linked bonds and then lost huge amounts of money. One investor here had bought a UK inflation-linked bond index fund and was down more than 20%. And actually, that wasn't even the worst of it. Because during 2022, UK inflation-linked bonds fell by around 46% peak to trough. Nearly half. Which raises a really important question. If inflation-linked bonds are supposed to protect investors from inflation, why did they collapse during the biggest inflation shock in decades? And why, despite all of that, does roughly a third of my own portfolio still sit in inflation-linked bonds today? And later I'll explain exactly how I've structured the inflation-linked part of my own portfolio. Because one of the biggest lessons from 2022 is that not all inflation-linked bonds behave the same way. But before we get to that, we first need to understand what these things actually are and how they work. Now, at their core, inflation-linked bonds are actually pretty simple. A nominal bond pays you a fixed coupon and then returns a fixed amount of money at maturity. So in this example here, you invest £100 into a nominal bond paying a 4% coupon. Every year you receive £4 in interest, and at the end you get your original £100 back. The problem is that inflation can quietly destroy the real value of those cash flows. Because if inflation is running at 3, 4, 5% or higher, that £100 you get back in the future may buy significantly less than it does today. And that's where inflation-linked bonds are different. With an inflation-linked bond, the principal itself rises with inflation. So in this example, the original £100 investment gradually increases over time as inflation rises. And because the coupon is calculated as a percentage of that inflation-adjusted principal, the coupon payments rise as well. So instead of fixed principal and fixed coupons, you now have inflation-adjusted principal and inflation-adjusted coupons. Now this is where inflation-linked bonds get a bit more interesting. Because inflation-linked bonds are not simply a bet that inflation goes up. What actually matters is inflation relative to what the market already expects. And that's where break-even inflation comes in. So in this example here, a nominal bond yields 4%, and an inflation-linked bond offers a 2% real yield. The difference between the two, 2%, is the break-even inflation rate. In simple terms, that means if inflation averages more than 2% over the life of the bond, the inflation-linked bond should outperform. If inflation averages less than 2%, the nominal bond should outperform. And this is really important because it means inflation-linked bonds are not magic. The market is already pricing in expected inflation. So when investors buy linkers, they're not just betting inflation will rise, they're betting inflation will be higher than what is already priced into the markets. So when we look at inflation-linked bonds today, one of the most important questions is, what level of inflation is already priced into markets? And these are the current break-even inflation rates. In the US, the 5-year break-even rate is around 2.7%. And the 10-year rate is around 2.5%. In the UK, the 5-year break-even rate is higher at around 3.5%, but it uses RPI, which runs roughly 1% hotter than CPI. So broadly speaking, markets are currently pricing in inflation returning somewhere around these levels over the medium term. And that creates the key question for investors. Is inflation ultimately going to be lower than markets currently expect, or persistently higher? Because if inflation remains stickier than these break-even rates imply, inflation-linked bonds should outperform nominal government bonds. And personally, one reason I still own a meaningful allocation to inflation-linked bonds is that I'm not entirely convinced inflation is going to smoothly drift back to 2% and stay there. Now, this chart shows the performance of inflation-linked bonds versus nominal government bonds in both the US and the UK since 2000. And what it shows is that inflation-linked bonds have actually outperformed nominal bonds over that period. And the underlying reason for that is that investors have consistently underestimated inflation. Inflation has tended to come in slightly higher than what markets originally priced in. And personally, I think there's a reasonable chance that continues going forward. Now, this is the really important part that many investors missed in 2022. Inflation-linked bonds are still bonds. And that means they're still highly sensitive to changes in real yields. And the key concept here is duration. Very simply, duration measures how sensitive a bond is to changes in interest rates and real yields. So a short duration linker might only fall 2% if real yields rise by 1%. A medium duration linker might fall around 5%. But a very long duration linker could fall 25% or more. And this is exactly what happened in 2022. Real yields rose extremely sharply from deeply negative levels back into positive territory. And when that happened, long duration inflation-linked bonds were absolutely crushed. This chart here shows the fall of a long duration UK inflation-linked bond. At one point, it was down 86%, which is extraordinary when you remember that many investors thought inflation-linked bonds were supposed to be the safe part of their portfolio. And I think this was one of the biggest investing lessons of 2022. Inflation protection does not mean low volatility, and not all inflation-linked bonds behave the same way. So after everything we've talked about, the volatility, the drawdowns, and the disaster in 2022, why do I still own such a large allocation to inflation-linked bonds? Well, firstly, I think there's a reasonable chance inflation stays higher for longer than markets currently expect. Not necessarily runaway inflation, but structurally stickier inflation than we became used to during the post-2008 era. Secondly, real yields are finally positive again. For years, many inflation-linked bonds offered deeply negative real yields, whereas now investors can actually lock in a positive return. Thirdly, I think they can still provide useful diversification against equity risk, especially in a world where inflation can hurt both stocks and nominal bonds at the same time. And finally, there's the risk of financial repression. Historically, one way governments have dealt with very high debt levels is through inflation running above interest rates for long periods of time. And inflation-linked bonds are one of the few assets specifically designed to protect purchasing power against that risk. So this is what the inflation-linked part of my portfolio actually looks like today. And the key thing running through almost all these positions is relatively short duration. Because I still want inflation protection and positive real yields, but I'm much less interested in taking huge amounts of duration risk. The core position is the iShares 0 to 5 year US TIPS ETF. This is really the simple passive core of the allocation, very low cost, short duration, and directly linked to US inflation. And because it's an ETF tracking short-dated US TIPS, it behaves very differently from long-duration linker funds. Then alongside that, I own the PIMCO Global Low Duration Real Return Fund. This is the active management component of the bucket. PIMCO can actively manage duration, country exposure, inflation positioning, currencies, and different parts of the yield curve. They can even short some parts of the curves and position tactically in ways passive funds can't. So the idea here is not simply to track inflation-linked bonds mechanically, but to have a more flexible strategy that may behave differently in different macro environments. But importantly, it's still relatively low duration overall. Then I own the Aberdeen short-dated global inflation-linked bond tracker. This is really the low-cost global diversifier within the bucket. Unlike the iShares ETF, it's globally diversified, around 60% US tips, but also UK, European and other global inflation-linked bonds. And unlike some of my other holdings, this one is not currency hedged. So it gives slightly broader global inflation exposure rather than purely US exposure. And finally, I own the Capital Gearing UK Index-Linked Bond Fund. The reason for this is mainly UK inflation exposure. Historically, UK inflation has often run hotter than US inflation, particularly because UK linkers are linked to RPI rather than CPI. But one problem in the UK market is that most passive UK linker funds have extremely long duration. And I'm not particularly interested in taking on large amounts of duration risk at the moment. So this fund is one way of accessing shorter duration UK inflation-linked bonds in a much more controlled way. So overall, this bucket is really built around inflation protection, positive real yields, some global diversification, and controlling duration risk. In a world where I think inflation is likely to be stickier and more volatile, this part of the portfolio aims to provide positive real returns, while also diversifying away from equities and nominal bonds, assets which may struggle in a higher inflation environment. And more broadly, one reason inflation matters so much in my portfolio construction is that I tend to think in real returns rather than simply relative performance. I'm not just trying to beat global equities. Over the long term, I'm really trying to grow purchasing power. And the benchmark I use for my portfolio is RPI plus 3%. So ultimately, I think the biggest lesson here is that not all inflation-linked bonds are the same. Understanding things like duration, real yields, and break-even inflation matters enormously. Anyway, thanks for listening, and please follow along for more updates about how I'm thinking about the world and my portfolio.